How would I see my
The slide.
my slide? David's welcome.
Okay, if the name comment, I can help you share. Have you downloaded the slide?
No, that's what I'll call stuff.
It's still not downloaded. It's still downloaded, that's fine. The same cannot download this stuff. So you have to try again. Then close the video.
Yes, definitely. Yeah, good afternoon to Good afternoon, distinguished ladies and gentlemen.
Good afternoon, sir.
Okay. So I'm here for our lecture. But before we introduce before we start what we are supposed to do today, if you have any question on what we did last week, the floor is open now for you to ask. You have any question on what we did yesterday, last week and last 2 weeks? Just let me know so that you can. Yes, I can see Bridget. Bridget, gift you also. Your hand is up.
Good afternoon, Prof. Please, we are finding it very difficult to hear you.
Hello. Yes, can you hear me now?
It's a bit faint, but we'll manage. Yes, Prof.
Yes. Can you hear me now?
It's okay. It's okay.
Okay. But we can also look at your gadgets and see if you can adjust it. All right. Anybody with a similar problem or anybody with the same problem? Is my voice loud enough?
Yes, it's coming up, Prof.
No, with
Hello?
please, it's a bit faint.
Hello now? I'm just studying. Hello, is it okay?
Yes, Prof. It's okay.
Your voice is far.
Oh.
Adjust yourself, please. Move away a little bit. You can hear.
Hello? Can you hear me?
Yes, Prof. I can hear you.
It's okay.
I
can hear you, but it's far.
Forward. Hey.
Please just look at your gadget because I'm shouting and the mic is close to my mouth. So I'm surprised that you cannot hear.
Yeah, I can hear you, mate. I can hear you.
Maybe you need opinion sticker. So you can affix one on your gadget and it will amplify everything because it's a multi-purpose sticker. Okay? It's almost through.
Okay.
So it's almost through. So I will signal you. Right. All right. So any question or questions? Where are my friends? I have some few names. Divine, are you here?
Prof, I'm here.
Mrs. Ado, are you here?
Prof, I'm here, please.
Okay. So how is Mr. Ado?
Mr. Ado is fine.
Oh, we thank God.
You want to say hi to him?
Oh, for security reasons, no.
Right, sir.
Because it will be an interference, he is by you, and I mean, there should be no room for any interference.
Okay, sir.
Where is Nana? Is Nana around?
Yes, sir, I'm here.
Oh, okay. And then my co-lecturer, Hannah, is it Hallelujah or something? Hannah. Hello, Hannah, are you here?
Yes, sir, I'm here.
Oh, okay. That's my co-lecturer. Uh, and where else? Daniela, Daniela, the Bank of Ghana lady, are you here? Daniela, are you here? Okay, Daniela is not here. And then my senior at the bar, the CSR man. Council, are you here? Council, are you here?
Sir, please, council has an emergency, so he's attending to it.
Hello?
Sir, council has an emergency, so he's attending to it. He will join later.
Okay. Okay, are you the wife or what?
No, classmate.
Okay. I'm surprised that you know his schedule.
Oh, okay, Prof. I should have said it, but since you have said it, I have to keep quiet.
All right, and then Dennis, yes, Dennis.
Prof,
And what?
Maria.
And the fertility
Maria.
lady, what is the name?
Maria.
Maria, yes. Right. Is Maria here?
Maria should be here.
Maria, are you here? All right, so we want to.
I'm around.
Prof, yeah, Musa, Land Commission. I'm sure you might need services with Land Commission.
Oh, is it Musa?
Yes, Musa.
Oh, okay, Musa. Yes, sorry. I almost forgot.
That's okay.
Your name. Okay, Musa.
Yeah.
Assalamu alaikum.
Wa alaikum salam.
Yeah, Jida.
Alhamdulillah. That's here.
Oh,
Yeah.
oh.
Thank you.
Atabi.
Allahu Akbar. Thank you.
Okay. So please, if you have any question on what we discussed last week and last 2 weeks, please let me have them. If you have any concerns, frustrations, disappointments, what have you that you want to? Let me know. Just a minute.
Yeah, okay.
All right. So if you have any concerns on what we discussed last week and the last 2 weeks, please let me know. If you have any question, maybe some clarification of something, whatever it is that you want to before we start today's lecture. All right. It appears that there are no concerns, there are no questions, so we can begin our. We want to look at measuring corporate financial performance. Measuring corporate financial performance. But I mean, let me maybe go back a bit. We have indicated that the main objective of the firm is to maximize the wealth of its shareholders. So the question is, and I think that we have discussed the condition that necessitates or that supports the conclusion that wealth has been maximized or not. You say that we can only conclude that our wealth has been maximized in a particular company that we have invested in, when what the company offers us, that the return that we receive from the company is greater than the returns that we could have received elsewhere if we had put our money elsewhere. That is the point that you must note, the condition under which we can say that the wealth of shareholders has been maximized. Now we want to learn how to measure wealth maximization first. Then we proceed to discuss how to assess the financial performance of an entity. And for example, you are the manager of a company. Your accountant has prepared the financial reports of the company and has presented same to you. How do you appreciate the content of the report, the financial reports? That is what we want to learn how to do. So basically, our discussion is in two segments. The first segment, we will learn briefly how to determine wealth maximization. And then the second part, we will learn how to assess the financial performance of an entity. I am proceeding on the assumption that I am dealing with managers or future managers, right? So we need to understand some of these things to help us. I've indicated that the nature of the course and also the fact that the time constraint will not permit us to discuss a lot of corporate finance topics. So I've carefully selected these topics, right, for us to discuss them. And I've just told you that those of you who may develop interest in finance, you can enroll after this program. You can enroll on any finance, MSc finance or MBA finance program to get more, insight into what finance is all about, right? Okay. Okay, so let's see. So our discussion, as I've already indicated, is in two parts. But before we go into the actual work, we need to familiarize ourselves with some concepts so that you'll be able to appreciate the discussion, better. And especially those who do not have business backgrounds, you may not, if we don't start by looking at these concepts, you may be confused as we move along. Income statement or profit and loss account, what is it? In fact, it's income statement, either income statement or profit and loss account. But now I think the current concept for the current one is the income statement. It used to be profit and loss account, but now they say it's income statement. And in it, you will find that the expenses of the company or the firm are matched with the incomes of the firm over the period under consideration. So in the income statement or the income statement of your company, you match, right, or the accountant will match the expenses that the firm or the company has made and the incomes that the company has earned, right, over the period under consideration. So let's say that in 2025, when the income statement of your company is prepared, it will be just, matching the expenses that the company will make in the year 2025 with the incomes that the firm or the company will generate in the year 2025. And when you do that, you want to know whether your operations over the period under consideration have been profitable or not. That is all that we want to do. We want to know. If you prepare your income statement, that is all that you want to know. You want to know whether you have operated profitably or not. That is all that you want to know in your income statement preparation. Now, it is prepared based on accrual concept, right? Which says that, all expenses that relate to a particular period, financial year, and all incomes that relate to a particular financial year must be captured in the income statement, whether or not they have been made or they have been received. Right? So, the expenses that were supposed to have been paid for, in the year 2025, just in 2025 as an example, whether or not we have paid them or not, we have to capture. So let's say that we're supposed to pay some rent, but we have not been able to pay, or we have paid some part, or we have not paid at all. And the rent for the year 2025, we have to capture it, right, in our income statement. Yes, some incomes we're supposed to have received, some people are supposed to have paid us, but you have not received that payment. Yes, once the payment relates to the year 2025, you have to capture it, right, in our 2025 financial, that income or income statement. So, whatever we get, right, so when you do the reconciliation, yes, whatever we get will be whether we have made a profit or we have made a loss. And the income statement is divided into three main components. We have the principal operations. That is where the actual matching is done. That's where revenues and expenses are matched, and that will result in what we call earnings before interest and tax. So when you match your revenues with your expenses over the period under consideration, the outcome is what we call the earnings before interest and tax. And we assume that we'll make profit anyway. We assume, but it can also be losses before interest and tax, right? But it's normally it doesn't occur that you make losses. Then, well, I don't know the kind of business you are, or the kind of firm that you are, that you make earnings or losses before interest and tax, right? So it's earnings before interest and tax. When interest and tax, when you match your revenues with expenses. Please, as I move along, if I say something that is not clear to you, feel free to ask to seek clarification in your own interest. And please don't be intimidated by the presence of anybody, and don't be intimidated by me, right? Just I am here because of you, all right? So if there's something that I say, all right, something I mentioned that is not clear to you, please feel free to seek clarification. And I also plead with members that when somebody is genuinely seeking clarification, don't intimidate the person, and don't get worried. Dennis, I can see that your hand is up. What do you want to say?
So I want to get something clear with regards to the reporting of the finance. Say you have debtors of 2,000 Ghana cedis. Debtors.
Yeah. Yes, I'm listening. Dennis.
You have people who receive only 1,000 cedis. Are you the financial year, or you have to record the 1,000 you received?
You see, I think please come again, because I did not. I think at some point your line went off.
Okay, so I believe I'm clear now.
Yes, I can hear you now. Yeah.
So you have to receive an amount of 2,000 Ghana cedis by close of, let's say, the year 2024. But the amount you were able to receive was 1,000 cedis instead of the 2,000. When you are recording the income statement, are you to record the 2,000 that you are supposed to receive or the 1,000 that you received is what you have to record.
And so you are saying that you were supposed to have received how much? You were supposed to, how much were you supposed to have received?
2,000 cedis, please.
2,000 cedis. And
yes.
you were
And you
how much?
You received.
Hello, your line is breaking. I don't know. You received how much? Yes, you see, whatever.
1,000.
Dual concept answers this question. Right. Whatever you are supposed to receive and whatever you are supposed to pay, right, for a particular financial year must be captured in that financial year's report. Right. That financial year's report must capture, everything that relates to the to it.
Oh, okay. Okay. All right. Thank you.
Right. But for your information, on your, what you are talking about, debtors, we don't account for debtors in income statement, right? We account for debtors. Debtors are supposed to be assets, current assets. So you will see debtors in
the balance sheet, rather.
In the balance sheet, yes. Right, you see debtors in the balance sheet. So, and somebody sang this. So, did I see Augustina?
Yes, sir. Good afternoon, please.
Oh, sorry, Augustina. In fact, how could I have forgotten your name? Hey, Augustina, sorry.
Sir, it's fine.
No, sorry, special Augustina. Sorry.
Sir, good afternoon.
All right, good afternoon.
Please, can I get the difference between revenue and income?
The difference between
revenue and income?
Generally, we could not. Maybe I know where you are coming from because of the. In fact, it's supposed to be what we have there is supposed to be, this is net income, right? Yes, net income. Net income. Because we can't say net revenue. Net income, yes, but generally, revenue and income. I don't see, a difference because they are just inflows, right? They are all inflows. Revenue, what you have generated, income, what you have generated. But, I think it's more of a, maybe I don't see the difference. So what you see there's supposed to be net income, right? Net income, right? Not necessarily. So I don't see any difference between the two. Bridget, your hand is raised. Is that
yes.
Is that Mrs. Ado?
Yes, Prof.
Okay, Mrs. Ado.
Prof, what about the difference between revenue and PBT?
Revenue and what?
PBT.
EBT.
Yes, profit before tax.
Oh, PBT. Oh,
yes.
It's also your income or your revenue, but it is revenue that you are yet to apply the tax rate to, right? Yes.
Okay.
Like the excess of revenue over or excess of income over expenses, right? But you are yet to apply your tax rate to it. That is why it's a profit before interest and tax. In fact, in some circles, they say profit before interest and tax. In some, they say earning before interest and tax. The value is the same because if you apply makeup to an old lady, the value is the same, or is the value different? Bridget, is the value different?
It's the same, sir.
Yeah, maybe it's different. Let me know. So it's a matter of, choice of words. Some will say profit before interest and tax. Some will say earnings before interest and tax. Right. A hand is up. Mr. Yaonyako.
Yeah, Prof. Good afternoon. Yeah, Prof, can the revenue be seen as the
Hello.
income?
I see that maybe your system where you are, there's some feedback echo in the background. So if you can position yourself well.
Okay, I'll look at it then. I'm having a problem. I'll come.
Maybe you need opinion staker. Or
Program again.
Get some opinion staker, and you'll be fine.
Okay, thanks.
Just below the pedal. Don't worry.
Yeah, it's
right.
right.
So what can we do? So can we proceed? Can we proceed?
Yes, sir.
Okay. So the next section, we are saying that the income statement basically has three sections or three components. You have the principal operations component, and then we have the financing cost section. This is where you account for the financing cost of the firm, such as the interest expense that the firm has incurred on the borrowings it has made. Right? Yes. So that this section, the financing section, that is what that's what is captured, right? There you look at the cost or expenses that you have incurred on the borrowings that as a firm you have made. You account for such costs here or such expenses there. Then the tax section will capture the tax that you have to pay, right, as a business. Now when you subtract or when you deduct the interest expense, that is the financing cost, and the taxes that as a firm you have paid, when you subtract from your earnings before interest and tax, the balance is what we call bottom line or net income. Right? Bottom line or what? Net income. And you see, this belongs to ordinary shareholders, where there are no preference shareholders. Right? Yes. That is what belongs to ordinary shareholders. The net income. So net income, the point that you have to note is net income belongs to ordinary shareholders, where there are no preference shareholders. But where there are preference shareholders, you have to account for the dividend payable on their shares, the dividend payable on the preference shares. Then whatever balance that is there automatically belongs to ordinary shareholders. So in the absence of preference shares, net income or bottom line belongs to ordinary shareholders. And so if you want to know you want to calculate what you will do today, if there is time, earnings per share, it is supposed to be the net income divided by the number of ordinary shares or the total ordinary shares that the firm has issued. That will give us earnings per share. Now the balance sheet. Now the balance sheet is also called the statement of financial position. And it's supposed to be the snapshot of the firm's accounting value for the particular date. And it shows what the firm owns and how it has been financed. And that is why the balance sheet is prepared using this equation, assets must be equal to what? Assets equal to liabilities. On the your left-hand side, you list all the assets made up of current assets and fixed assets and current assets. Then on your right-hand side, you will see the liabilities and the capital. And so you have the liabilities, we have current liabilities. Sometimes you just put it this way: creditors amount falling due within 1 year. We call the current liabilities. Then you have creditors amount falling due after 1 year. Then we have the equity, right? We have equity, we have preference shares, and if there are some reserves, they won't be there. But the total of both sides must be the same. So the total current assets must be equal to the total. No, the total assets must be equal to total liabilities. So we have the current assets. We have liabilities. Liabilities are the financial obligations of the firm. The assets are the owners of the firm, right? And the assets, we have the current assets or the current liabilities. The current assets, their values change frequently. The fixed assets, they are the current assets, they are what you normally refer to as the working capital items, right? Working capital items, they are part and parcel of the day-to-day operations of the firm. The fixed assets, they remain in the firm for some time. They are more stable. Their values usually do not change very often as the current liabilities, current assets, their values do not change, things like that. Then you have the liabilities that I've already indicated. You have the current one, and usually the current one, the maturities are 1 year or less, up to 1 year. The long-term maturities go beyond 1 year. Then you have the cash flow statement. The cash flow statement, in fact, in Ghana, a company is supposed to prepare 3 financial statements. A furnished team will be furnish the shareholders with such statements. Income statement, balance sheet, and then cash flow statement. The cash flow statement is supposed to trace the inflows and outflows of cash over the period under review, right? Yes. So you want to monitor. Cash flow statement will help you monitor where cash has come from and where cash has moved to. Within the period under consideration. Now, we want to look at, if you are trying to analyze, we are doing financial analysis, where do you get that information? That's the sources of information for assessing the financial performance of the firm. We have financial statements, that's the income and the balance sheet. You can download as you see there if you want to assess the financial statement of a company that has made its statement. You want to assess the financial performance of a company that made its shares available. Its financial statement available online. You can download and begin to assess. But there are other sources that provide such information. We have financial databases such as data stream, sales, values. Then you have the internet, so that some companies, they publish their financial statements online. You can go there, download, and then analyze their performance. Now, the users of financial information, shareholders, one. Investors, yes, as an investor, before you invest in a firm, you want to know how the firm is performing. How do you know how a firm is performing? By assessing or analyzing its financial statements over some years. Company managers must also know the performance of their company so that they will know whether they are doing well or they are not doing well to make amends. So the structure of our discussion, which I've already talked about, we have it in 2 segments. We have the shareholder, measuring the shareholder wealth maximization or shareholder value maximization, and then assessing the general performance of the firm. right? So we turn our attention, and I believe you came or you are with your calculators, or even if you don't have calculators, you have your phones, you can still have access to the calculator on the phone. So let's look at the measures of shareholder wealth maximization. We have market value added, market to book ratio, economic profit, and economic value added. So these are the measures that we are going to learn how. These are the measures of wealth maximization or value creation, right? So market value added. I mean, once you know the number of shares the firm has issued and the market price of the share is you multiply the market price by the number of shares the firm has issued, right? Yes, and then you subtract the book value of equity from it. So let's say that, and in the example I have projected, or I have shared with you. Please, are you with me?
Yes, sir.
Yes, sir.
Yes, sir. Yes, sir. Yeah,
Okay.
So,
the market value added, the formula, the market value added. Please follow me, and whatever we are going to do, make sure that you participate in it in your own interest. It's supposed to be the market capitalization minus the book value of equity. Please, you see. All right. So, how do we get the market capitalization? When you multiply the total number of shares a firm has issued by the market price per share, you get market capitalization. Right? You get market capitalization. So, if you look at it,
Sir, please come again with the market.
That is, if you multiply the market price per share of a company's share by the number of shares outstanding, that is the number of shares the firm has issued or the firm has sold to its shareholders, right? You get market capitalization. So in our example, you see the outstanding shares, that the number of shares the firm has issued is what? Is 200,000 shares. And the market price, please, you see?
Yes, sir.
yes, Prof.
Yes. So the market price per share is 4 cedis. So the market value or the market capitalization will be 4 cedis times what? Times 200,000 shares. 4 times 200,000 shares. And that gives us what? 800. So the market value or the market capitalization is 800,000 Ghana cedis. Now, if we know let's say that the total book value of equity, and that is the total book value of shares, right? Total book value of equity. Please, if you don't understand, if I use a term that you are not familiar with, just let me know. I will explain it to you. Okay. It's better for you to get understanding from me than to seek it elsewhere. Because if Jesus is there, you don't go to Peter for healing or for a miracle.
Oh, please, therefore, I didn't get it well.
No, therefore is the market price.
Right.
The market price per share. The market price per share. And but you understand the 200,000, the number of shares the firm has issued, right? So once you know the market price per share, and you know the number of shares the firm has issued, you multiply the two, and that will give you the book value. That will give you the market value or the market capitalization, right? So when you go to the balance sheet, you will get you get what? The book value. Right. So all the items you see that their values, all the items you see in the balance sheet of a firm, all the values there, we call them what? Book values. Are you with me here? Hello?
Yes.
Yes. So we take the balance sheet of a company. All the values the values of items in the balance sheet, they are all called what? Book values. Now, if you want to get the market value of an asset, you multiply. You have to know the market price of the asset, and then you multiply by the quantity of the asset, right? Yeah, and that will give you the market value, right? So, assuming that, I think if you look at this example, the market value, the book value is 700,000. So the market value added becomes what? Market value added equals 800,000 minus what? Minus 700,000. And so that gives us what? 100,000. So that is the value the managers of the firm have added to the funds of shareholders, or the wealth of shareholders. Right? They have created what? 100,000 CD value. So that's the market value added. So the market value added is the market value of equity minus what? The book value of equity. And now if you get the market value of equity, it is the number of shares outstanding times what? Times the market price per share. The book value, the total book value is what is stated in the balance sheet of the company. So when you subtract the book value from the market value, you get the market value added. And have I made myself clear? Hello?
Yes, sir.
Okay.
Sir, please kindly go over it again.
No, what I'm saying is that if you want to know the market value of an asset, let's say that where do you work?
Sir, please, I work with
where do you work?
Sir, please, I work with the armed forces. I work with the Ghana Armed Forces.
Hey, I salute you, madam. I salute you.
Sir, please, I'm not a soldier.
Okay. You're not an officer.
No,
she's not yet an officer.
All right. So assuming that you work, maybe you are with MTN or whatever, MTN shares are traded, and assuming that in the books of or in the balance sheet of MTN, the total book value of MTN is 700,000. Right. The total book value of equity is 700,000 because that is what is stated, in the balance sheet of MTN. So that is the book value. Now, if you want to know the market value, you have to know the number of shares MTN has offered to the public for subscription. And we in this example say that it is 200,000 shares. I'm just making 200,000 shares. Now, assuming that the market price of the market price per share, right, of MTN is 4 cedis. Now, if you want to know the market value of MTN, right, it is the number of shares MTN has issued multiplied by the market price per share, right? And so if you multiply 4 by 200,000, it gives you what? 800,000. So that is the market value. So we know that if you want to know the market value added, it is the market value minus what? Minus the book value of equity. And then you know the book value of equity to be 700. So if the market value is 800, then 800 minus 700 gives us what? 100,000. So that is the market value. That is the value that we say managers of the firm have added to the wealth of shareholders. Charlotte, are you okay now?
Yes, please. Thank you, sir.
And so the market to book ratio, it is just, instead of just taking the nominal 100,000 as if you express the two as what? So the book, so instead of subtracting 700 from 800, when you are using the market to book ratio, it is what? It is the market value divided by the book value, the market value of equity divided by the book value of equity. Right, yes. So, so market to book value method. Market to book value method. Please, do you see my electronic board?
Yes, sir.
Definitely we can do. LV.
Yes, sir, we can see.
So it's market. Oh, market value of equity divided by book value of equity. All right. So we know the market value of equity to be how much? 800,000.
800.
And the book value of equity is
700.
700,000. So you divide, you express your answer in times. So if you divide, what do you get?
1.142.
1.142.
142.
So it means that the managers of this firm have multiplied the value of shareholders' wealth by what? 1.14 times. Right? The higher the ratio, the better. Right? The higher the ratio, the better. Right? So that is how we apply the market to book ratio and also the market value added. Now we turn our attention to economic profit. Unfortunately, I don't know whether I shared the sample balance sheet with our class group. If I have not shared, then respectfully, I would ask that the Kumasi rep just take a shot of what I shared with the sheet I shared with you and put it on your platform so that our class group too will have access to it. With the front and back, you take the front and you take the back and share on your platform so that they can follow our discussion. Yeah, Emmanuel Agbeku.
Yes, sir.
Agbeku.
Yes, sir. Sir, sorry, I wanted to know how we got the book value of 700.
Hello?
Yes, sir.
Yeah.
Please, I wanted to find out how did we get the book value?
For the book value, I've indicated that the book value, you get it from the balance sheet.
Oh, okay. Okay.
Or of the balance sheet of the company whose shares you are trying to, or whose wealth you are trying to, or whose shareholders' wealth you are trying to, measure whether it has been maximized or not. So the book value, you get it from the balance sheet of the company.
Oh, okay. All right. Thank you.
And this one, you have just assumed it, right? You have just assumed it to be 700,000, that's all.
Oh, okay. That's fine, sir. Thank you.
Okay. All right. Now, so, class, have you shared, or if it has been shared with a rep of Facebook? No, but you have a common platform, so you can just take a short. All right, so let me just try to it. So that everybody can have access to it. Even those who got the printout, they might have placed it somewhere. For example, Mrs. Ado, she might have placed it somewhere that she cannot find.
I still have it.
Right, okay. Okay, Tina, do you still have it? Do you have it by you?
Oh, okay.
You have your sheet by you?
Yes,
So
please.
we have the picture, but it's not clear.
Oh, um, I mean, then somebody should take, no, somebody should take a good picture of that. Let me see. My laptop is off. Let me see if I can share it now. I can share that. It's not clear, but so anybody with the maybe the class reps camera is not that good. Anybody with a good camera on the phone should take a shot and share. So Mary, if you're able, if you get a new one, let me know. Maria, how are you?
So I'm fine.
Okay. Dennis was talking about you and
So we have a new one, but we can manage.
okay. All right. Thank you.
So I've said it again.
Okay. That's Augustina.
Yes, please.
Yeah. Okay. 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 So we want to look at the next measure, and that is economic profit. Please follow me carefully. Don't let anything distract you now, so that you can appreciate what it is not difficult at all. Once you understand it, that's all. So economic profits, I have projected the formula. Please, do you see the formula?
Yes, sir.
Okay. Right. So, I mean, I will not repeat it. So we need to get a terms in the formula. We have what? Operating profit. Now, once you are talking about profits, you go to income statement. So go to the income statement portion of the sheet you have. And we are saying that the operating profit here should be EBIT, that is earnings before interest and tax. So please go there and then take the earnings before interest and tax for us.
Three, two, two, four.
3224.
3224. 3224.
3224. Please, has everybody seen it? Please, I beg everyone to participate in what we are doing. Please, everybody, stop whatever you are doing. I know that you are in the comfort of your home. Some of you may be with your children, your husbands, and your wives, and whatever. Please, follow the discussion. All right. The next term is what? We have 1 minus T. The T there is tax, right? It's tax. That's the corporate tax rate, right? How much is the corporate tax rate?
$1092.
No, the corporate tax. The tax rate
25%.
is what?
25%.
25%.
Please, where did you get that? Is it on the additional form or part of the
Yes,
balance?
it's part of it. It says behind the sheet.
At the back of the sheet.
Okay, so it's 25%.
Have you seen it, Mary?
Yes, sir.
Okay. The next question is KO, right? And that is the cost of capital of the firm. cost of capital of the firm.
12%.
It's what, 12%,
12%.
right? Please, have you all seen it?
Yes, sir.
All right. The next thing is capital employed. The CE is capital employed. How do you get capital employed? You subtract total current liabilities from total assets. That will give you capital employed.
Sir, can you please repeat that?
You subtract total current liabilities. Current liability, total. You subtract it from the total assets. That will give you capital employed. Another thing is you can add long-term liabilities to equity or capital, right? Long-term liabilities to capital. That should give you the same outcome. It's like going to Accra from Kumasi, traveling from Kumasi to Accra. You can go through in Sawam. You can also go through Koforidua. At the end of the day, you get to Accra, right? So current liabilities are total assets minus current liabilities, or long-term liabilities plus what? Capital, equity, preference shares, all put together, reserves, all put together should give you capital employed. So how much is our total assets?
10,752. I don't know if
10,000.
752.
52.
Yes, sir.
Okay. Then the long-term liability, current liabilities.
Current liabilities 3039. 3039.
So if you subtract 3039 from 10,752, what do you get?
Hello, sir. Please, I'm a little bit confused. You said the capital employed, we get it by subtracting total liabilities.
Subtracting total current liabilities from total assets.
So, sir, is it the
Okay.
same thing as total liabilities and shareholders?
Hello?
Hello, sir, can you hear me?
Yes.
So, please, I was asking, the total current liability, is it the same as the total liabilities and shareholders' equity?
Total what?
Liabilities and shareholders' equity.
No. The total liabilities, no, if you say total liabilities captures current liabilities and long-term liabilities. We are interested in current liability, total current liabilities.
So the 10,000 is factoring for
Hello?
the total. Hello, sir.
Yes.
The 10,000 Ghana cedis is factoring the total liabilities and shareholders.
So 3,000
That's total assets.
Hello,
I
sir.
don't have the sheet. Yes, somebody
Sir.
quoted it.
Oh.
Yes.
Sir, then the 10,000 is wrong because
It's not wrong. Total assets is 10,752.
no. Because the total liability is 5,481.
Total current liabilities.
No. Total liability.
Because
Sir, please.
the
total current
total
liability.
Total assets is 10,752.
Yes.
It's
Then
correct.
total liabilities.
Total current liabilities.
And we are looking for current liability.
Total current liability.
Total current
liability.
Yes,
Sir, the answer is 3,039.
It's 39.
3,039 cedis for the total
Yeah.
current liability.
That's true. That's true. that is Grace, eh?
Yes.
It's Sheila.
Augustina.
Augustina, okay. The special one. Okay. Alright. Okay. So,
Hannah, are you clear now?
hello?
I'm asking if Hannah has got it now because she was a bit.
My co-lecturer is the one having some difficulty.
Yes.
Hey, Hannah, have you seen it now? Hello? Okay. So if you subtract 3,039 from 10,752, what do you get?
7,717.
7.
This is 13 or 17.
7. Okay. So this is our capital employed. Now we have all the terms. So now we can estimate our economic profit.
So it's okay. All right.
It's correct.
Yeah.
Okay. So our economic profit becomes our operating profit is how much? 3,224 times 1 minus 0.25, okay, minus the cost of what? Cost of capital. Cost of capital.
0.12.
So 0.12 times what?
7,713.
7713. So somebody should summarize this for us. Has somebody been able to summarize it? Yes, Joyce, your hand is up. Do you have any question?
Doug, good afternoon. Please, you said to get the capital employed, right? It is
Yes.
total current liabilities minus total current assets.
No, total assets minus total current liabilities.
Total assets
Yes. Minus total current liabilities.
total current liabilities. Okay, thank you.
Total assets. So you get 1,492.
You get what?
1,492.44.
1,492.
92.44.
Point what?
44.
Point
Please,
44.
if someone else can confirm.
Confirm.
Okay. Any confirmation? Can somebody confirm?
Confirmed.
Right. It's okay. All right. Okay. Joyce, your hand is still up. Okay. Any question on what you have done? All right. Now, how do we interpret what we have here? The interpretation is simple. Once your economic profit is positive, some value has been added. The higher the economic profit, the better. Right? So, but once it is positive, it means that some value has been added. Are we okay? Can we proceed? Now we turn our attention to economic value added. And yes, I want us to use this formula. It's projected there. At this stage, please, the interpretation is very important. When you get the outcome, how do you interpret? Right? That's what, because at the managerial level, it's, the interpretation. Because sometimes some of these things can be done by the people, the subordinates. When they submit the report, the interpretation is in your hands. Mr. Ofori.
Sir, I just wanted to maybe go over the process, the formula to arrive at that was used to arrive at the profit 1,492.44. So
Okay.
the formula is what I wanted to repeat.
Oh. The formula was projected before we got the answer. This is the formula. Operating profit, that is earning before interest and tax, right? Then we have 1 minus T. The T there stands for tax, the corporate tax, right? Minus KO. KO there stands for cost of capital of the firm. Then CE stands for capital employed. And we have said that the capital employed, we can obtain it by subtracting total current liabilities from total assets. That's what we did. Right? Yes.
All right, sir.
Hello,
So,
sir.
value added is also a measure of shareholder wealth maximization. Right? And the formula is projected on its own. The formula is projected here. Please, do you see it?
Yes, sir.
Okay. That is, EVA is after tax interest plus net income divided by total capital minus cost of capital times total capital.
Sir, so the cost of capital stands on its own.
Yes, it stands on its own. Thank you very much for bringing that out. Very, very important. It's a standalone term. Sister Mary. Thank you.
Yes, sir.
Okay. So the cost of capital is not part of the ratio. It's a standalone term. So you see that the line doesn't affect it, right? Then you have the total capital. So let's try and get the terms. No, so you want to get the after tax interest. How do we get it? Now, we need to get the interest the firm has paid. A hand is up. Whose hand is that?
Yeah, Prof. If you can project the slide.
I have projected it.
No, the particular sheet you are working on, you can project that one alone. So they can
No, we need the formula. We need to.
The formula is projected there, don't you see?
Yes, we see that. He wants you to make the word big.
Yes, expand your
it's not big. No, because I have to divide the screen into two, use part as the electronic board and part as the projecting board. That's what makes it small.
Okay, Prof. Let's continue.
Because if I have to enlarge it, it means that I cannot write. Okay. Whose hand is up again? Ms. Ofori, do you still have a problem? Okay. So let's go to the interest. Just go to the income statement and take the interest the firm has paid. Do you see the interest? Do you see?
Yes, sir. It's 64.
It's what? 64. 64 CDs. So if you want to get the after-tax interest, what we are looking for is the adjusted interest the firm has paid. So we are going to adjust 64 by the corporate tax rate. That was the after-tax interest. So it's supposed to be 64 into bracket. What is the corporate tax rate? What is the rate?
25%.
1 minus 0.25. So 64 into bracket 1 minus 0.25. If you summarize, what do you get?
$48.
48. So that would be the after-tax interest. So after-tax interest. Okay. Now, we have what is our net income? How much is it? You get it from the income statement. Net income. Is it indicated there?
Yes, sir.
2068.
58.
What?
2068.
2068. Right. Cost of capital. Cost of capital, how much is it?
12%.
12%. And then total capital, we take it to be capital employed, right? That's the capital the firm has used. The total capital the firm has used. The same as capital employed. Okay, Tina, your hand is up. Do you have anything to say?
So please, the after tax, I want to get the calculation. So is it like the after tax will be interest expense? How do you get the
1 minus the tax rate?
So yes, so it will be the interest expense times the corporate tax rate.
Corporate tax, yes.
Okay, that's what I wanted to be sure. Okay.
Okay. So our total capital is what? 7713. Right. So if we want to get our IVA, it becomes after tax interest, which is what? 48 CDs divided by plus what? Plus what? Our net income. How much is our net income? 268. All divided by 7713 minus our cost of capital is what? 0.12, right? All into brackets multiplied by what? 77713. Somebody should summarize this for us. Please. I let everybody follow what we are doing. Right? If you don't understand something, draw my attention to it. I will explain it to you. Instead of keeping it to yourself, let me know so that I help you before it is too late.
Okay.
I've told you that if I have to examine you on this, the formula will be provided. Right? There will be a formula sheet. The formula will be provided. But if you don't understand it, you cannot apply the formula. So understand it, get understand it, so that if the formula is provided, you will know how to apply it. All right.
So I got 1190.4.
It's what?
1190.44.
1190.44.
Please, can someone confirm?
Any confirmation?
Confirmed.
Confirmed. All right. Confirmed by Mrs. Ado. Correct?
Yes, Prof.
All right. So we have 1190.44. That is okay. So, and what is the interpretation? The higher the IVA, the better. But once the IVA is positive, what it means is that some value has been created for shareholders. We want the IVA to be positive and high, right? But once it is positive, we can say that it's some value has been created. But the higher the value, the better. Okay. Right. Any question or questions on what you have done so far? Or we want to proceed to the next segment of the discussion, that is assessing the financial performance of, of a firm using financial ratios. So can we proceed?
Yes,
Can we
please.
proceed? Or you want some break?
So we can proceed. Let's proceed.
Hello, sir.
Hello.
So you see, it's like we some of us, I feel like we are rushing fast on the points. So sometimes the point, we are going fast.
Hey, Mr. Fire Officer.
Plenty of them, they are quiet. They have not even solved it. We are backing up. Yes, sir, and we are going. But it's like we are going fast.
Mrs. Ado, am I rushing?
Moving from the next point to
The thing is that if you are attentive, you can follow what Prof is doing. That's what I think. But if you don't understand till you ask, then we can go back.
Hey, but I even ask questions. Ask questions if you don't understand. We don't
understand, no.
Hey, Maria, a whole banker, Maria. You have been deducting service charges. Sometimes you increase service charges. Yes, the transaction, whatever will be there. Your account back.
You see,
After deducting our money, you okay. All right, Mr. Obey. Where lies your problem? Fireman.
I tell you the whole show, but I don't want to most
The
of us
whole
don't
show.
because it's like it's going fast. You see,
yes,
as you said, they are not like
Mr. Obey.
taking it slowly.
Mr. Obey.
Yes, sir.
You are the class rep.
Okay, sir. So,
And
sir,
you
I'm
are a
quiet.
class rep. Oh.
Yes, sir. I'm quiet, sir.
No. I'm not in any way trying to gag you. No, I can't. I'm not gagging you, but I'm just saying you are the class rep.
Yes, sir.
In case you are forgotten, because you are supposed to, you are supposed to encourage your members so that those who don't understand are supposed to come to you for assistance. So if
Okay.
if you the leader you are crying, it means that hey, your followers are in trouble. What, Maria? Sister Maria.
Yes, sir.
Did you share the sentiments of your class rep?
Yes, please.
Yes, please, we do.
Charlotte,
Yes, sir.
do you share the same sentiments?
Sir, please, 100%.
Well, I can understand that. You are the only coach with this challenge, because some of you are not familiar with figures.
Sir, the truth of the matter is some of us are not business students. We are just trying to. The truth of the matter is some of us are not business students, so we are just trying to understand.
Yes,
So,
and I understand you. I am not worried at all. I understand you, and I'm not surprised at all. I understand where you are coming from. And that is why I've been hammering, I've been saying it that be careful to take the quantitative approach or the quantitative route as far as this course is concerned when I'm teaching it at this level, or when I'm teaching corporate governance and strategy management, strategy leadership students, because of the backgrounds, because of their backgrounds, right? So I understand. I'm not surprised at all, right? Yeah, and I understand. What I would
thank
say,
you, sir.
yes, what I would say is that just master courage, and then you pay attention to what we are doing. You follow, you participate. If you just watch, yeah, it will not be part of you, right? You may not be able to get it, so you participate. If you are recording something, yes, you participate. We are trying to pick the figures, you participate. It will help you to appreciate whatever we are doing. But if you just become a passive member of the conversation, it becomes difficult for you to appreciate what you are doing. All right. Augustina.
Sir.
How do you feel about it? I mean, are you okay with it?
Yes, please, I'm okay.
Share the sentiments of your class rep.
Sir, I'm okay.
You're okay.
Yes, please.
Okay. Where is Daniela? Daniela, are you here?
Prof, I'm here.
You are hiding yourself. I mean.
Oh, no.
You are hiding yourself.
Prof, I haven't.
So, Daniela, how do you feel? I mean, are you okay with what you are doing, what you have done so far?
Yes, please. I'm okay.
You're okay. Okay.
Yes, please.
All right. So let me try to go over, since it's coming from the class rep, because maybe something may be pushing him, because if the whole class rep will cry this way, then meaning that there is fire on the mountain. Right? Yes. All right. So economic profit are projected. Class rep, Mr. Obin, do you see the formula there?
Yes, sir.
Yes, sir. Yes, sir. Okay. Do you have the balance sheet and the income statement in front of you?
Yes, sir.
Yes, sir. Yes, sir. All right. Now the operating profit, we are saying that it's supposed to be EBIT. So economic profit, we have please, those who don't understand, please follow. I'm going over. No, so economic profits, I projected a formula there, so we want to pick the terms. So operating profit, we are saying that it should be what? Earnings before interest and tax. So go to the income statement and pick it for us. So I want Mr. Obeng to pick it, to just call the number, the figure you see there, edit, call it. Mr. Obeng, what is the operating profit, which is our earnings before interest and tax? How much is it?
64, sir.
It's what?
64.
Operating profit to
3224.
it is what?
I see 3.
3,224.
3,224.
Okay. Mr. Obeng, have you seen it? Hello?
Yes, sir. Yes, sir.
Okay. The T in the formula or the model is for tax. So corporate tax rate. Can you give us a corporate tax rate, Mr. Obeng?
25%, sir.
25%. The next is what? KO, and that is the cost of capital.
12%.
Is what? 12%.
12%, yes. 12%.
Then we have C. C is the capital employed.
That's 7,713.
How did you get it?
Total assets minus the current liability for the first one, which
Okay.
give us the.
Then, Mr. Obeng, I suggest to you that you understand this.
Yes, sir.
I'm suggesting to you.
Yes,
If
sir.
you like, I will say, I'll put it to you that you understand what we have done.
Yes, sir.
Okay. So it's 7713.
Yes, sir.
Right? Now we have
Yes,
all
sir.
the terms ready, so we can estimate our economic profit. So our economic profit becomes operating profit, that is 3,224.
Sir, that's not the operating profit.
Operating profit. Earnings before interest and tax. Is that not it? That is it. We are saying that operating profit here should be earnings before interest and tax.
Okay.
Okay. Times 1 minus 1 minus what? 0.25. That is the tax rate. Minus the cost of capital is what? Is 0.12 times 7713. So summarize this, Mr. Obeng, summarize this for us. Augustina, your hand is up. What do you want to say?
Hello, sir.
Yes.
Confused now because for the first one that we did, we calculated for the after tax, and the after tax was interest.
No.
They've gone back. They've gone back to the previous one.
Augustina, this one is different. This one is economic profit. We will go.
Oh, okay. Okay. That's where the confusion was.
I have gone back. Right, I've gone back to economic profit. Okay. Right. So if you summarize, what do you get? Mr. Obeng?
So 1492.44. 92. 92.
Point
0.44.
144. So do you understand it now? Sister Salos, Mr. Charles Osei Atumai, what do you want to say?
Hello, Prof. Please, over here when we're computing the figures, I saw 25%. I also saw cost of capital to be 12%. Now, when we're calculating or when we're summarizing, I realized that we have 1 minus 0.25. We also have 0. So I want to understand that over here we have 25%, then we also have 12%. So why the 0 point? Thank you.
I don't know if critical. Can somebody help Mr. Osei?
Yes, sir.
12% is 0.12.
So it's 12 divided by 100.
Mm-hmm.
And to give you 0.12, same as the
Yeah.
divided by 100.
So Mr. Osei, are you okay now?
The calculator. Punch it on the calculator.
Mr. Osei, are you okay?
Hello, sir, I'm okay. Just that I just wanted to understand why we didn't go straight. For that is all. We are not mathematicians, so.
Yeah, I understand you. I understand you.
Yes. Thank you.
And it's good you have asked.
Yes.
So yes, ask whatever question that you want to ask. Right? Because I am here because of you. Right? Yeah. So somebody say your wish is my command. What the ladies always want to hear. That your wish is my command. All right. A hand is up. Mr. Osatima, your hand is still up. Okay. So we come to economic value added. EVA. And the formula is here. So Mr. Obin,
Yes, sir.
are you okay? With
This
economic
one,
profit?
yes, the economic profits are okay, but with this one, I didn't see anything. With the economic value added, that one there.
So we are coming to economic value added.
Yes, sir.
So after tax interest, so give us the interest that the firm has paid on its borrowings. You get it from the income statement. So go to the income statement and call the interest the firm has paid on its borrowings.
$64, sir.
So it is what? 64.
Yes, sir.
So we are going to adjust it by the tax rate. That's what it is, after tax interest. So how much is our tax rate? The tax rate.
I'm coming on. Check. $25%. Oh.
It's 25%.
Yes.
And if you want to do the adjustment, it is the interest. So after tax interest, it becomes 64 into bracket 1 minus 0.25. So if you summarize, what do you get, Mr. Obin?
Sir, 48.
So 48. Am I rushing?
No, sir.
If I am running, just let me know so I slow down. I will crawl, right? I'll crawl just for you to understand.
Yes,
so we have what, 48? Do you understand it now?
Yes, sir.
Okay. Is there anything that we need to know? We don't need so. We have 48. So after tax interest is what? 48 cedis. Now our net income. Net income is what?
I'm coming, please.
Income. You
Two.
Yes. Is
2068.
2068.
Yes.
Okay. Cost of capital.
12%, sir.
12%. Total capital. I've indicated that is a capital employed. And the capital employed, how do we get it?
7713.
So capital employed, you obtain it by subtracting current liabilities from total assets, right? And it's what?
713.
13. Okay, is there anything outstanding? No. The cost of capital and everything is there. So now our IVA becomes what? 48 plus 2068 divided by what? 7713 minus 0.12 all multiplied by 7713. So Mr. Obin, summarize this for us.
Minus will. Calculator. Sir, please, this one I'm coming. Oh, sir, I'm coming, please. It will take time. Let me. Sir, 1190.44.
So
190.4.
So are you okay now?
Yes, sir. I'm okay now, sir. Thank you, sir.
All right. Anybody with a concern? Anybody with a concern? Hello? Hello?
Everything is fine.
All right. Okay. So let's now turn our attention to ratio analysis and all these, in fact, these are the ratios that we are going to use to assess. In fact, so we are assessing the financial performance of the firm in these 5 areas. Now, as managers, we are supposed to assess our performance, how we have performed over a particular financial year. So from time to time, every year, at the end of every financial year, your financial reports are prepared, and you need to make sense, or you need to make meaning of what the reports carry. And to do that, the common means of the common means that you can use is what? The financial ratio, or the financial ratios. And so in our example in this class, we want to assess the performance of a firm in 5 dimensions. 1, profitability. We want to know whether the firm has performed profitably over the period under consideration. We also want to assess the efficiency of the firm. That is, has the firm been efficient in its operations, right? In terms of the use of its working capital items, has it been efficient? Well, to do that, we need to employ activity or efficiency ratios. Then we also assess the liquidity of the firm. And in fact, when we talk about liquidity, liquidity in this context, we are referring to the preparedness of the firm to meet its short-term obligations when they fall due. But when we talk about asset liquidity, and listen to me carefully, we are looking at the convertibility of the assets. That is, we want to look at how easy it is to convert the assets into cash without incurring so much in just loss or cost. Right? But in this particular context, liquidity refers to the preparedness of the firm, or the readiness of the firm to meet its short-term obligations when they fall due. So we look at the liquidity ratio. We also look at gearing ratio, also called capital structure ratio, also called bankruptcy ratios, or in short, financial risk ratios. So these ratios help us, or leverage ratios, you can also call them leverage ratios. They help us to ascertain whether the firm is susceptible, whether or not the firm is susceptible to bankruptcy risk or not. Then the investor ratios, that will help investors to know whether it's advisable to keep their investment in the firm, and even to it can also be used by potential prospective investors to know whether it is advisable to commit their funds to the business. So that's what we want to discuss now. Assessment of financial performance using financial ratios, and the assessment will be in these 5 dimensions, right? Efficiency, liquidity,
when they bring the
investor.
No, it's a special part. So you are going to bring your own for you.
Okay.
This one is I'm going to my friend. I just want you to be safe in the car.
Kindly mute yourself, Sister Charlotte. I think you are forgetting to mute yourself.
Sorry, sir.
If you are not careful, please, it's advisable that you mute yourself and then unmute when you want to ask a question or make a contribution. Because some of you, I think you are in your homes, for example, Mrs. Ado, and Mrs. Ado is by her. If you are not careful, whatever conversation that's supposed to be private will be public. We don't want that, right? So mute yourself, right? So for profitability ratios, there are many. but we are going to focus on just two. It's just that we want to learn to calculate just two, but there are many, right? There are many, but you focus on the two common profitability ratios, and these are return on assets and return on equity, right? So return on assets, ROE, the formula is projected, and you have, as you can see, I've projected two formulas. We have the first one being the total assets, and then the second one we have what average assets. Sometimes it is believed that for us to be more accurate, we need to find the average of the assets, right? Last year's total assets, what was it? This year's total assets, what was it? We have the two, then we divide by 2 to get the average asset. But in our context, in our example, or in class, we want to go by the first formula, which is after tax operating income over total assets. So our ROA, right? Our ROA is, but you see, let me even, before we get into upstream, when you calculate your ratios, and please listen to me carefully, there are 3 ways of interpreting the outcomes. I mean, when you have your ratios, there are 3 ways of interpreting the ratios. We have the time-based interpretation or trend analysis, where you just suppose what you have obtained against the previous year's ratios and see whether you have made progress or you have retrogressed. That is what we call time-based or trend analysis. Then you have the I, that's industry-based, also called benchmarking, where you try to compare what you have obtained, your ratio, to the ratio of the industry in which you operate and see whether you have made progress or you have not made progress. That is what we call industry-based interpretation of your results. And from strategic management perspective, it is the best among the 3, because that will tell you, that will help you know how you are performing relative to the average player in your industry. Then the last one is expectation based. Usually at the beginning of the financial year, firms will have the expectations. Then when the financial year ends, they will look at the actuals. So what you are doing is that you want to look at the projections against your actuals and know whether you have achieved your targets or not. Right? So we put the 2 together and say, and call it what? The 3 together and call it TIE. T is time-based interpretation, I is industry-based or benchmarking, and then E is what? Expectation-based interpretation. Right? So let us be guided by what I've just discussed with you. So our ROA, right? Because we are talking about profits, return on, we first you go for or we will pick the after-tax operating income. Do you see something like that in the income statement? After-tax operating income, do you see it, please?
So would it be the same as the net income?
Yeah, it's supposed to be the net income, right? After-tax operating income. How much is it?
2068. Is that it?
Total assets.
Total assets.
10,752.
It's what?
10,752.
Okay, so if you summarize, maybe you can multiply your answer by 100. God, you're talking about rate. If you summarize, what do you get?
$19.2%.
It's what? It's what?
19.2%.
19.2%. Any confirmation?
Yes, sir.
Confirm.
20.23.
Okay.
Yes, sir.
Okay. Now, the higher the ratio, the better. Right. The higher the ratio, the better. The ratio is supposed to help us know how we have utilized our assets to, or to know whether we have utilized our assets to generate more profit. So the higher the ratio, the better. It means that you have utilized your assets well to generate what? Profit. So the higher the ratio, the better. Now, we turn our attention to return on equity. So return on equity is what? Net income. I projected the formula there, net income. Net income over what? Equity. How much is our net income?
2068.
And then our equity.
5272.
Equity, yes, you get it from the balance sheet.
Yeah,
What is our equity?
5272.
Total shareholders equity is what?
5272.
5272. So you express the two as ratio, and that gives us what? Mm-hmm.
9, 2, 3. 39.23.
39 point what?
23.
23. Okay. Mr. Obi, are we speeding? Are we speeding?
Okay.
Okay. Are you following the discussion?
It's 39.2.
Okay, 39.2. Okay. The higher the ratio, the better. The profitability ratios, the higher they are, the better. Right? Now, let's proceed to the
Sir, please, let's finish writing it. Please.
That is done.
Yes, sir.
That's not enough for you. Okay. All right. So we want to look at the next ratio, which is the activity or efficiency ratios. They measure how short-term assets and liabilities, the working capital items have been managed by the firm. All right. So we have these ratios: stock turnover, debtor days, and debtor day, creditor days, and then cash conversion cycle. So let's begin with stock turnover. Right. Stock turnover. The ratio is here. The formula is projected. Do you see the formula? I think we need to hurry up a bit, otherwise we may not be able to go far. So stock turnover. The formula is projected there. So how much is our stock? Another name for stock is what? Inventory. Okay. So please go to the balance sheet and call the stock figure for me.
It is 1,091.
1,091.
Yes.
That's
1091.
1091, yeah. 1,091, yes.
Inventory. Okay. 1091. Then cost of sales. Do you have information there?
So is it the same as cost of goods sold?
Technically, it not the same, but in our context, we can take the two to be the same.
Okay.
Right. So, but have I provided any additional information about this? Last week, I think are we supposed to break at 2? When are you supposed to be on break?
So we thought you finish everything so that we close once and for all.
People will test me in their heart, especially Mrs. Sabo.
Okay, so then 2 o'clock we'll go for a break and come, sir.
Nice already.
Yeah, sir, it's 2, so we'll close.
Okay, so let's break for 30 minutes and continue at 2:30. All right?
Okay, sir.
2:30.
2:30. We'll do 2:30 to what time?
6 o'clock.
2:30 to 6. Okay, thank you.
No. I think by 4:30 we should be out of it. Or when we finish, tomorrow we look at the qualitative aspect.
Okay, thank you.
Okay.
Hello, Bismarck. Bismarck.
Maria, hold on.
Some of you are downloading my na yenti ebi why. Dennis.
Yeah.
Mr. Muya, Yanda London.
Definitely we'll do that.
Okay, thank you.
Hello. Hello. Hello.
Yes, Paul.
So we can prompt the you can prompt the others to join, but we want to resume.
Hello, sir. Please, your voice is far.
I said that prompt your colleagues to join, but I want to resume.
Okay, sir.
That is Auntie Margaret, eh?
Yes, please.
Auntie Margaret in Accra.
Yes, please. Yes, please.
Okay. All right. So we want to continue. So our stock turnover, that is, we need to look at it. We need to get the stock, and you have picked the stock from the balance sheet. Which is 1091. Okay. Cost of sales. Do you have any information on it at the back of the sheet? If you don't have any information, then we will use the cost of goods sold, which is what?
6859.
6859 times 365 days, which means that our answer will be in days.
Yes.
Right. Okay.
58 days.
It's what?
58 days.
58 days. Okay. The efficiency ratios, we want them to be as low as possible. So the shorter the stock turnover days, the lower the cost to the firm of holding stock. So we want the days to be few, right? We want the days to be few, meaning that we want to look at how often we are able to get or we are able to dispose of or sell our stock. Because if we hold stock, we incur costs, right? There are costs for holding stock. One is you may have some of the stock, especially if you're a supermarket operator. If you have a lot of stock, I mean, your boys or your girls will steal. They will prefer you. They will take some of the goods without you knowing. You have a lot there. And some of them are likely to become obsolete, right? Because some stock or some goods have expiry dates. Once they expire, you cannot continue to sell them. So you want your stock turnover days to be as few as possible, so that you avoid the cost of holding stock, right? So let's assume that the average player in the industry has stock turnover days of 60 days. How would you describe or how would you assess the performance of this firm? The firm's stock turnover days is 58 days, or stock turnover ratio is 58 days. Then the average player in the industry has a stock turnover days of or stock turnover ratio of 60 days. How would you describe or how would you assess the performance of this firm? This is average industry ratio. And here is the ratio of the firm. I want you to comment on the performance of this firm as far as stock turnover days.
The industry with the 58 days will be profitable more than the...
Hello, Nana.
Hello, sir.
Uh-huh.
I was saying that the industry with the 58 days turnover will be more profitable than the one with the 60
So this
days.
one is our firm. The 58 days is the firm we are dealing with.
Okay.
This is average industry ratio. That is the industry in which the firm operates.
Okay.
The average player has 60 days.
Okay.
But our firm has 58 days.
I mean, our firm is doing well.
Yes. Our firm is doing well in terms of turning over its stock. Right? Because remember that the shorter the days, the better. Right? 58 is less than 60. So this one is better. Right? Carry.
So in an exam setting, we'll be giving the industry
whatever. You see, I told you that there are 3 types of analysis that we can do, depending on the information you have.
Okay.
We have trend analysis, right? We have industry-based analysis, and you have
expectation based.
So the choice of one is contingent on availability of information.
Oh, okay.
Right? Okay.
So which one are we doing now?
We have to look at either interpretation.
So we are currently doing the industry base.
The industry base, because I've given the industry average.
Okay. Thank you.
Right? I've given the industry average, and you have juxtaposed what you have obtained against the industry average. So we are doing benchmarking or industry-based interpretation.
Yeah.
Right? Then we have data days. Mind you that we are still on hold on Dennis Okofo. How may I help you? Mr. Dennis Okofo, please unmute yourself and speak. Mr. Dennis Okofo, I want to hear you. Your hand is up, so speak. Okay. So the formula is projected there. Do you see the formula, please?
Yes.
Do you see the formula?
Yes, sir.
Okay. And so we have debtors. Another name for debtors is what? Accounts receivable. Another name for debtors is what?
Receivable.
Receivable.
Accounts receivable.
Another name for creditors is accounts payable.
Payable.
Okay, accounts payable. Right. So our debtors. Do you see the debtors figure in the balance sheet? Accounts receivable.
948.
Okay, it's 948.
948. And credit sales.
795.
Credit sales. Additional information is provided. Please check the additional information.
Okay, it's 40%.
40%
of net
of
sales. Net sales.
net sales. So find 40% of what? How much is our net sales?
It's 16,448.
So find 40% of 16,448.
That's 6,570.
6579.2.
It's what?
6579.2.
6579.2. Okay, so you can just omit the 2. Right, so
Okay.
6579. So our data date now becomes
948 divided by
948 over 6579 times 365 days.
53 days.
So we'll get approximately 53 days.
Approximately 53 days.
Days.
Any confirmation? No, it appears that some people, when they end on break, they have still not returned. Please, I prompt them to return, because they are not. The point is that I won't take any blame because I'm taking my time to. If you don't go through, you don't get it, and then they cancel. Then you see, human beings, we tend to blame our environment, our external environment for our misfortunes or our failures.
External locus of control.
Well,
Yes.
confirmed. 53 days confirmed.
Yeah, so
52.59.
Okay.
So the half day is more than half. The 9 days makes it more than half. So we'll take the 53 days.
Okay. Now, 53 days.
Sir,
Yes.
please, I have a question.
Yes.
The 6579, is it the net sales? Because I'm not
No,
getting it. Or it was already
additional information provided in the 40% of net sales.
sales. So with the 6579, you've already calculated it.
Yes. It means that we
Okay.
have found 40% of
of that.
The net sales is 16.448.
Okay.
No, 16.448. Sorry.
16,448. Yeah, exactly.
Yeah.
Oh, but sir, you see, okay, yeah, that's fine.
Okay. So let's assume that last year, the creditor days or the stock turnover ratio was 50 days. So last year's debtor days, 50 days. I mean, comment on the performance for the firm.
Yeah, it didn't do well this year.
GC.
It didn't do well this year because last year was 50.
Last year's ratio was 50 days. This year's 53. Comment on the performance for the firm.
So does it mean that the firm is taking a longer time in
the firm is what?
Taking a longer time in receiving from their
no,
debtors?
I said comment. So why are you asking me? Comment and then if you see what.
So, in my opinion, I think this year the firm has taken a longer time in recouping their money from their debtors as opposed to last year.
Exactly. That's good. That's Mary, eh?
Yes, sir.
Okay. Okay. So that is it. So it means that the firm has dropped in terms of its collection of debt. Last year it took the firm 50 days to collect its debt when it sold on credit. Right. But this year it has taken it 53 days to do so. So it means that in terms of debt collection, some deterioration has taken place. Then the question is, what has occasioned it as a manager? You need to find out. Is it that your sales force or the sales people, that the sales department, they have become a bit relaxed, or is it that the debt collection strategies are not, potent now? What should be done? Has there been some, complacency on the part of somebody sleeping on the job or something? As a manager, you need to investigate. Mr. Nyako, your hand is up. What do you want to say?
Yeah, Prof. I wanted to ask that, considering the days taken to recover, you take into account the amount involved.
Is that what do you mean?
Looking at what we just record, last year it took the company 50 days to recover its debt. Now it's 53. And the analysis is that the firm is not doing well in terms of debt recovery. And I wanted to find out, you have to consider the amount involved so far as the debtors are concerned.
Guys, whether you have to consider the amount involved.
Yes, sir.
Well, if you want to consider the amount involved, then it means that you will not be able to make any headway. I mean, it's all about the collection. Whether the amount involved is big or small, they have to be collected, right? So we just want to know how long it takes to collect your debt. And in fact, it doesn't account for the amount involved, right? It's about collection. Are you recouping your funds from your debtors? That's the question we are seeking to answer. But your concern is also legitimate, because if you are able to collect 50 CD debt faster than someone who is able to collect 5 million, that's fine. I mean, that amount, but there we are not interested in the amount involved. We are interested in the days it takes for you to collect your debt. Mr. Nyakwa, you answered?
Yes, Prof. I'm okay.
Okay. So, creditor days. The formula is projected, I mean, shared with you. You see that trade creditors over credit purchases or cost of sales. Right? Do you have trade creditors? Do you have trade creditors? Another name for trade creditors is accounts payable, right? Do you have that?
Yes, sir.
Oh, let's hurry up because the time is.
Yes, sir.
It's what?
2244.
It's what?
2244.
244.
244. Okay. Then you have our cost of sales. You see, credit purchases or cost of sales, right? I have provided additional information, but you see that we have two options here: credit purchases or cost of sales. So we have taken the cost of goods to the cost of sales, right? Though technically there's a slight difference. But so let's use the cost of sales. How much is it?
The sales was
6859.
Huh?
6859.
It's 6859. So our creditor base that becomes over 6859 times 365 days, and that gives us what?
$33 days.
That gives us
33 days.
it's what?
33.
Approximately 33 days, sir.
33 days. Okay, that's okay. All right. So the next thing, the next ratio. So yes, let's say that we have the average player in the industry uses 40 days.
Sir, please hold on.
I'm not getting the 33 days, so.
It's what I got 119.
Me too.
You got what?
119 days.
119
days.
Yes, 119. I think Mr. Nyaku failed to multiply by 365.
So 119 days, right?
Yeah.
Okay. But maybe for now, don't worry so much about the correctness or whatever of the edition. The most important thing is you getting the understanding, right? So for now, for the example that we are, trying to deal with, right? So that let's say that the average, okay, so let's say that the average industry player uses 100 days. Comment on the performance of our firm. The industry average is 100 days, and our firm has 119 days. comment. Can somebody comment? Ms. Ofori, or no, Mr. J, do you want to comment on it?
Please, let me try.
Charles Gifty.
Yes, so since I'm saying that with the previous year, they were able to make payments partly to their suppliers earlier compared to the current year. So it took them, say, 100 days to make the necessary payments they were supposed to do. But in the current year, it took longer days.
So we are talking about industry average, though.
No, sir.
This industry, the 100 days, right?
Yeah.
That is the industry ratio. This is what this Fed, right, has achieved. 119 days. And they want to know, compared to industry average, has this firm performed well or not?
Sir, please, I want to come in.
Is that Mary?
Yes, sir.
Okay.
So, in my opinion, other organizations in my industry are doing better than me because I am taking a longer time paying my debts.
Okay. Okay. So that is in fact, that is how it's supposed to be. The interpretation is that our firm has taken a longer period to settle its debt. Right. So yes, it is not doing well in the industry. But if you look at the other end, because this one is about debt payment, in a way, our firm has benefited from its credit purchases more than the average player in the industry. Because you see, when it comes to finance, though it is not good that you must be quick to collect your debt, but be slow to pay your debt. So if you buy on credit and you have a long period to pay, what it means is that your creditors, in a way, have funded you in a way, because see, by letting you keep their money for a long period, more or less they have funded your operations.
Yeah.
Or you don't understand, you don't get what I'm trying to say.
Yes, sir, it makes sense.
It's very clear, sir.
Yes. So yes, from efficiency point of view, you can say that, well, we have not been efficient because we are not paying our debt quickly. But in a way, we are benefiting because we are keeping the money, the funds of our creditors. We can make some returns on them. However, if it is not something that our creditors have sanctioned, but just that we have decided not to pay them quickly, it will get to some point that they will blacklist us, so that when we need credit, purchases, they will not grant. Right? Because if you are taking a long time to pay me, why should I continue to sell to you on credit? It may even be an indication that you are struggling, you are about to collapse. That is why you are finding it difficult to pay your debt when you create them. Or you get me?
Yes, sir.
So yes, on the face of it, yes, we are not doing well because our industry players, they are quick. The other industry players are quick to pay their debt, but we are taking a longer period to pay our debt, which may indicate that we may be struggling. That is why we are not doing it. But in a way, it benefits us because in finance, the principle is be quick to collect your debt, but be slow to pay your debt. But you see, it has some negative consequence. That is, if your creditors respond by tightening their credit terms or even refusing to grant credit, then you see that you in the future you are likely to be in trouble. Okay, can we move on? Is this one here?
Sam, yeah. Sir, I wanted to find out something.
Okay.
Yes, I think we have the debtors. We need that there's 60 days of average in debt collection. But with the creditors, do they also have the same days as average, like the collection or debt collection? Do both debtors and creditors also have the same average days? Is that how it's supposed to be? That's what I want to find out.
I don't get what you are. What point are you?
Okay, we already worked on the debtors. Debtors, you, our firm, we are collecting the money from the credit sales that we have made. And this one, we are on creditors. Creditors, those that we have also bought from on credit. So I wanted to find out what are both the debtors and the creditors. We have the same average number of days as average, in which we can pay or we can collect.
Put it there. The averages I am putting are just the figments of my imagination. I have created them.
Yeah,
okay. So anyway, I have created them just for analysis, just for our discussion.
Okay, but in reality, do we have it like that? I understand the point.
I'm not aware of anything like that. Please.
Oh, okay.
Just the realities that will show. The industry averages, that is, the industry averages will indicate that how the firms within the industry are performing. That will be what will be if such data are reported. Yes, that will be the realities, not imaginations.
Okay. All right. Thank you, sir.
Okay. So we have cash conversion cycle, CCC. The stock days plus debtor days. What is our stock ratio? Stock turnover days.
53 turnover days.
It's what?
58 days.
58 days. Our debtor days.
119.
No, debtor days.
53.
53.
And our creditor days. 119 days. You are likely to get something negative, right? But because these are, fake, should I say, fictitious figures, you are likely. But the point is that the longer the cash conversion cycle, the higher the investment in working capital, vice versa, right? So we want to know our, cash conversion cycle. That is the period for which working capital financing is needed, right? So it's supposed to indicate the extent of investment, that working capital investment that the firm or the owners of the firm or the managers of the firm have made, right? But this one will get negative, so it's very difficult for us to comment on it. But in reality, what you have to understand that this is how we estimate the cash conversion cycle. You take your debtor days, you take your creditor, you take your stock days, debtor days, and you subtract your creditor days from the total, and that will give you the cash conversion cycle, right? Cash conversion cycle. Okay.
Hello, sir. So, in a situation where, let's assume that we got a positive figure.
Yeah.
What would be the interpretation?
So, the interpretation is that the longer the cash conversion cycle, the higher the investment in working capital. So let's assume that in the first the creditor days that we calculated, I think somebody gave us 33 days. So if we use the 33 days, if you use the 33 days, you are going to get a what? You're going to get a positive outcome, right?
Yes.
So what will you get if you use the 3 days? What will you get?
78. 78.
You get 78.
Yes.
Yes. So it means that we have 78 days to convert our stock, debtors, our stock and debtors into what? Into cash. And then what it means is that we have invested a lot in working capital, right? And that is why we able to I think we have enough, right, to be able to pay our debt, right, our creditors, and still manage. So yes, we may not need much investment in working capital, right? Yes, we will not need much investment in working capital because at least you look at the stock days, the debtor days, and then the creditor days. And you have about 78 days there. So we may not need we don't need much working capital, like much investment in working capital. Now, Bridget, your hand is up.
Yes, Bob. Can you please take the interpretation of the 78 days again?
Oh, so does it mean that you were not paying attention or what? But if we go back and forth, yeah, it's already 3 o'clock. Please, I beg everyone that when I'm talking, please, for the sake of the time, because we have less than 2 hours now, we have a lot to cover. Today, this is the only topic that we are treating. So please, when I'm talking, please, everybody listening, right? But I just finished talking, and so okay. Now, what I'm saying that, and I think I have even projected the interpretation on the board. If you look at the left-hand side, I don't know whether it's the same as your left-hand side or right-hand side.
Yes,
this ratio indicates the period of time for which working capital financing is needed. And they say that the longer the cash conversion cycle, the higher the investment in working capital. And I'm saying that yes, if you look at the 78 days, then what it means is that we may not need much working capital investment, right? Because you look at it, and I think they are giving initially it was negative, and then just for interpretation, I just used the 3 days which was initially given, right? And I've just concluded that looking at what we have there, we may not need much working capital because it appears that we have enough, right, in the Fed, right, and we may not need much working capital injection, right? So Mary, who asked that question? Who asked the question?
It's me. Please.
Yeah, please.
Yes.
So as we move along, please pay attention so that I don't have to be going back because we have a lot to discuss. Today we have. I'm sorry, we have had only one topic. We have a lot of topics to discuss. Hannah Alagwe, or have I pronounced your name well?
Yes, please.
Yes, that's my co-lecturer, right? Hannah, what do you want to say?
So please, I want to confirm that, so with the explanation given for the 78 days, where our former answer was in the negative, does it mean that the firm will need more?
No, I mean, in practice, the reason why we change that in practice, you may not have, you are not likely to have negative cash conversion cycle. Right. So that's why I use the 3, which was wrong, just because what we are doing now, we want to just understand so that in practice, when we get real figures, be able to appreciate.
All right. Thank you.
So please, for now, I think I've indicated for now, don't be so much concerned about the figures because we are using these figures for us to understand the concept, right? So that when in practice, when you get the real figures, you'll be able to appreciate them. But just get the understanding. That's what at the moment you should focus. That's what your focus should be. Okay. Can we move on? Hello.
Yes, sir.
Sir, you can move on, please.
Well, are you tired?
No, sir.
Okay. Bright, are you there? Bright, are you there? Hello. Bright, are you there? Mr. Bright, is it Bright or Pink? Are you there? He's gone. All right. Okay, so let's move on. The next thing is, so it means that we have come for efficiency ratios. Now let's turn our attention to liquidity or solvency ratios. And here the common ratios we are looking at are current ratios, quick ratio, and then cash ratio. Our focus here, please, is on whether or the preparedness or the readiness of the firm to meet its short-term obligations when they fall due. Right? Yes. So we want to know if our creditors, our trade creditors are demanding payment of their debt. Can the current assets of the firm pay? That's what we are interested in. Or do we have enough liquid assets to pay our debt when our creditors are demanding payment? So the first ratio we are considering here is what? Current ratio. And the formula are projected is current assets over current liabilities. Here, we are not expressing our answers in days, please. Right? We are not expressing our answers in days. Okay. So current assets over current, tell me the total current assets. Uh-huh.
4169.
It's what? 4169. 69. Oh, current, then the current liabilities. Uh-huh.
5481.
54.
No. 2244. You know. It's 3039. Hey.
3039.
The current liabilities. The total current liabilities. Right?
Total current liability.
Total current liability.
It's what?
3039.
3039. Yes. 3039. So our current ratio becomes. Okay, so now you have a problem.
Yes. Sorry, so formula is
What is the balance sheet?
Yeah, I'm with the balance sheet.
Okay. Current liabilities. Do you see?
Yeah, I see
current liabilities.
Yes, I see 224.
Account payable.
Yes,
And
795.
then other current liabilities.
Yes, please.
So the two put together.
We'll give you the total current liabilities.
So are you okay now?
So then the formula will be current assets over total current liabilities.
Oh.
Or Sana.
That's what I mean. So current liability.
Sir, please, I didn't get you.
So you need to.
So you only want to see the word total. Why is current liability?
Put it there, total current liability. Put it there.
Yes, sir. Thank you.
You this lady.
Over 3039. So somebody should summarize it for us.
1.37.
1.37.
1.4.
So 1.4.
Yeah.
1.4.
Approximately 1.4.
Approximately 1.4. So we just relate it to 1. So 1.4 is to 1.
Okay.
Right. Now the standard that is recommended by financial analysts is that the current ratio of a firm should be 2:1. All right. And so if we juxtapose this against this rule of thumb, right, or this standard, the standard of 2:1, what can we say? Or we can even look at it from, let's say last year, our current ratio was 3:1. This year, it is 1.4:1. Comments on the liquidity performance of the firm in terms of current ratio. What can you say? Last year it was 3:1. This year it is 1.4:1. Comments on the performance of the firm. Oh, nobody. Okay, divine.
Right, Prof. So it means that last year was better because we were able to meet our short-term obligations better than this year, looking at the rate, the ratio. It means that out of every one current liability, we have 3 current assets to settle it. And looking at this year, out of every one current liability, we have 1.4, which is lower than last year's performance.
Okay, so it means that we have dropped, right, in terms of our liquidity, that is our preparedness to pay our short-term obligations or to meet our short-term financial obligations when they fall due, right? Okay. Thank you, Divine. That's a class rep, Kumasi class rep, right?
Yes, Prof.
Okay. Then we have quick ratio. The formula is projected there. Please, do you see it?
Yes, sir.
All right. I mean, the morale has gone down.
Let me see it.
It appears the place is quiet. People are not participating.
The day has been full of calculations. The day has been full of calculations. From morning to evening, calculations. Wow.
My job, I went to 4 board on their mouth.
Sir, so please, in this case, the stock is also part of the whole.
What?
The stock is not on its own.
No, so you subtract the stock from current assets, right?
Okay.
And then you divide the outcome by the current liability. So it is current assets minus stock divided by current liabilities.
Okay.
Now, Somebody will ask, why are we subtracting stock from current assets? Can somebody guess? Well, in the first one, we use the total current assets and the total current liabilities. This one, we are taking out stock from the current assets. So can somebody guess why this is done?
Okay, sir. So I think because the stock, we still have it like in stock, we've not sold it. So we can.
Is that Mary Abner?
Yes, sir.
Okay, Mary. Yes, you have. Please go beyond the current level. You have an idea. Go beyond that. You see, the reason is simple. We want to check the preparedness of the firm to meet its short-term obligations. If at the time that our creditors are demanding payment, or at the time that obligations are due, one, there is no market for the stock we have.
Okay.
Two, maybe the stock we have has become obsolete. Three, the stock is stolen, right?
Okay. Yeah.
Or the stock is burnt, anything. So we want to know if at the time that our creditors are demanding payment or our financial obligations are due, if we cannot sell our stock, if there is no stock, can we still pay or can we still meet our obligations? That's what we want to do. That's why we are taking out the stock. Because some stock, or some goods are seasonal. Can somebody tell me some of the examples of goods that are seasonal?
Like agrochemicals.
Agrochemicals, Umbrella, okay. Hello.
Christmas tree.
What?
Raincoat.
Maybe.
He said Christmas tree.
Okay.
Stationery.
Okay, yeah, that's good.
Stationery.
What? Stationery?
Raincoat.
Raincoats, okay.
Tomatoes.
What, tomatoes?
Tomatoes.
No, tomatoes.
I know we always use tomatoes.
Why it becomes so abundant?
So, what about hookah?
Well, please, it's not this now. It's everyday job.
It's not this now.
And don't say.
Oh, okay.
It is now high in demand in summertime.
Okay. So let's try. We have our current assets. Minus what? Stock over. So what is our total current assets?
184.
4169.
Oh.
4169.
4169.
Okay, sorry. 4169 minus
285.
The stock inventory.
285.
1091.
1091.
Hey.
Please, where are you picking the figure from?
Gifty.
The stock is 1091.
Gifty. I have over there. Gifty. Do you see well?
1, 2, 3. Yes. 1, 0.
Inventory. Okay, 1091.
No, current, then the current liabilities total. 3039. So, summarize it for us. Please, in case you are presented with, financial statements for your assessment in an examination, please, when you are picking the figures, I'm not saying that is the case, but in case, right, in case you are examining on this, please take your time. But even use your pen to connect, right? Right. So you trace so that you pick the right figures. It's very, very important. Take your time. Don't be in a rush. You don't panic. You don't panic at all. Take your time and do it. Right? Because it's a matter of just taking the figures. That's all. Once you pick the right figures, once you know the formula, you pick the right figures, you are there. Okay. So if you summarize, what do you get, please?
1:1.
1.
1:1. 1:1.
1:1. Approximately.
Yes.
1:1. The financial analyst expects that 1:1 is acceptable. Right? Financial analysts usually consider a ratio of 1:1 acceptable. So in terms of the literature, we can say that this is acceptable. Right? Yes. That is even without our stock. Without stock. So in case our creditors are demanding payment, alright, approximately our current assets will be able to meet our current liabilities equally. So 1:1. So it means that yes, we are ready to pay. So in case we have to pay our creditors without selling our stock, we can still pay. Holding other factors constant. Right? Okay. So that is quick ratio. Then we have what? We have cash ratio. Right, the cash ratio. Now what you have to understand is that for the liquidity ratios, the higher the ratios, the better. Right, the higher the ratios, the better. But from risk-return perspective, right, if a firm is more liquid, right, that firm is likely to have less returns, holding other factors constant, because we have learned that the higher the risk, the higher the return. Yes. I think we have learned that. Yeah. So if a firm keeps more liquid assets, that firm is not likely to, earn much compared to a firm that keeps less liquid assets, right? So bear that in mind. So I think when we get opportunity, or if you get opportunity to discuss working capital, you understand it, that it's very difficult balancing the two. The equation. That is, you want to be liquid and profitable. Liquidity and profitability, usually they are not compatible. Right? Yes, they are not compatible. Okay. Right. So a cash ratio. The formula is to get that cash plus marketable securities over current liabilities. Do you have cash? Do you have cash there?
But sir, we have cash and marketable securities.
Cash and marketable securities. How much?
Cash and marketable securities. 1844.
1844. Is that the case?
Yes,
Yes.
sir.
And then the current liabilities,
3037.
huh?
3039.
3039.
3039.
39. Okay, so summarize this for me. Mm-hmm.
1:1.
Is what?
1:1. It's giving 0.6, so we can ratio it to 1.
Oh, you're wrong. It's 0.6.
0.6
0.6.
is to 1, right?
Yeah.
0.6 is to 1. Right.
Yes, sir.
The higher the ratio, the better. So, this, it may not, what it means is that, in fact, in percentage terms, it means that the cash and marketable securities of the firm will be able to settle current liabilities about 60%. 60% of the current liabilities will be, could be settled by the cash and marketable securities the firm has. Right. Yeah. But with this ratio, the higher the ratio, the better. Right. The higher the ratio, the better. However, if the firm has the borrowing capacity, right, then it may not be a problem because, I mean, for a short notice, the firm will be able to organize a loan, right, to pay off its trade creditors. Bismarck, your hand is up.
Sir, with the formula as stated, cash plus marketable security, I thought it would be maybe
I don't want to
the cash.
saying.
Oh, maybe very full market for me.
Marketable security. You want to do what?
I thought the cash as is the cash will come one 444 plus another one.
Take your mic in.
Oh, but in the example, you go there, it's cash and market, so the two have been put together already. So you just take the figure.
Okay.
In the balance sheet, you have cash and marketable securities put together. So what you want to watch, and the relationship between them is multiplicative. So if they have been put together already, you just take the everything.
Sir, I understand what you are saying. I understand, but you see the formula when it stated cash plus marketable, so that's why I thought the cash will be same as that one.
It means that the relationship between them is additive. So if you find in the balance sheet that the two have been put together already, you pick the figure. And you don't have to worry yourself.
Notice, sir.
Yeah. Okay. Okay. Why you today you are not are you part of the Government Eaters Association?
Sir, please come again. Is it?
Are you a member of the Government Eaters Association? Do you belong to the association?
No, sir.
The Government Eaters. And then it's your hand is up.
Sir, per the calculation, I had 0.6, but the answer per your dashboard is 0.6 is to 1. I want explanation.
No, you relate your answer to 1. It's the dream that Mr. Okofo, you have not been paying attention. You have just related it to 1. That's all.
Okay.
You have not been paying attention.
I didn't get that point.
Are you alone in your room?
No.
Okay. That is why.
Thank you, sir.
That is why. But if you are not alone, you are always distracted. Your attention is divided and all that. Okay. Okay. Now let's turn our attention to the next set of ratios. We have capital or gearing or leverage ratios, right? And these ratios measure how a business finances its activities in terms of equity and debt. So what that we are trying to do is we want to know, we want to look at the capital structure of the firm, right? And in fact, we can say that these ratios help us to determine the financial risk of a firm, the financial risk of a firm. And the financial risk of a firm, we are looking at whether the firm is prone or is susceptible to bankruptcy. Because the reason is simple. If a firm borrows too much, at some point, it may not be able to settle its debt. And the creditors will force the firm into bankruptcy. Take the firm to court to initiate bankruptcy proceedings for the firm to be declared bankrupt, and then the assets, the liquid assets of the firm sold to pay the debt. So we are considering two ratios here. These ratios are debt to equity ratio and then capital gearing ratio. So debt to equity ratio, I've projected the formula on the screen. You see long-term debt over share capital and reserves. Okay, so long-term debt, do you see it in the balance sheet? Can anybody help us? Mr. Kato, are you here?
2048.
2048.
2048.
You're so quiet for me today. Is it that Mr. Ado is around? That's why today you are so calm. All right. So long-term debt,
2048.
And then we have other long-term liabilities. Do you see? So we have to put the two together.
Yes.
So put the
Okay.
two together. If we put the two together, what do you get, please?
Two, 4, 4, 2.
2, 4, 4.
2.
All right. And then the share capital and reserves. Do you have reserves? Check the balance sheet. Do you have reserves?
No.
So normally the reserves could be in the form of profit and loss account. You will not have something like reserves. You may have profit and loss account. Yes, reserves. You may also have something called reserves. Yes. So there's something like that. So what do? We take the equity. We have what?
So
We have
what
total
about
shareholders' equity.
retained earnings?
Retained earnings. Yes, that's good. Who is speaking, Mary?
Yes, sir.
Hey, a professor of finance.
No, but I see retained earnings in the balance sheet. That's why I'm asking.
So it's also for retained earnings, profit and loss account, reserves. Yes. Okay. So Mary, Professor Mary Abena Yekun Boache.
Please, I beg you. I'm still learning. So I'm lost, too. So I'm lost.
Who is lost?
Tell me.
Is it that Timothy Forest or where? Is that Augustina?
Yes, please.
Okay, where lies your difficulty?
I can't see the return in addition to it.
I mean, there's nothing like that. There's nothing like that in this example. But I was just trying to let you know that in case you should.
There is.
Addition to retained earnings.
There is. It's in the balance sheet. Addition to retained earnings.
Oh, no. We don't have anything like that in the balance sheet. We are taking items from the balance sheet.
Okay. Well
Because
noted.
what we are talking about capital structure. And once we are talking about capital structure, your focus should be on the balance sheet.
Balance sheet.
Okay.
Right? Yes. What appears in the balance sheet is what you are using. Right? Okay. So total shareholders' equity. We don't have reserves. We don't have whatever. So total shareholders' equity, how much?
5272.
5272. So our debt to equity ratio becomes 2442 over 5272. And that gives us what? Gives you your hand is up. What do you want to say?
Sir, please, how did you get the 2442?
We put the long-term debt figure and the other long-term liabilities figure together. So put the two together. So add 394 to 2046. So if you summarize, what do you get?
Please, so other long-term liabilities, is it not 394?
Yes, 394. So you add 394 to 2046.
048.
You will get 2440.
I know. You won't get 2440 because we are 46. Oh, okay. So please. Okay, this one is 46. Okay, please add the rest.
You get 2440.
No.
No, it's 48.
It's 2048.
Plus 8 or 46.
48. It's 2048 plus 394.
Okay.
Is it 2048 or 2046?
48.
It's 46, so please look at it.
Okay,
so what plus 8?
It's 6. It's 6, it's not 8.
So 6 plus 8. 2046.
It's 8. We have
It's
8. We are holding it.
8.
Okay.
You have to clean your eyes.
It's 8.
So,
yes. It's 8, but it's not clear.
Okay, don't worry. And so if you put the two together, what do you get, please?
2442.
2442. Okay, so summarize for us. Multiply your answer by.
And you get 0.46.
So multiply
100.
Just 46.
46%.
Now, a firm is said to be highly geared if its debt to equity ratio were greater than 100%. 46% is not greater than 100%. So which means that this firm, our conclusion is that it's less what? Geared. That means that its bankruptcy risk is low. Right? It is far below the benchmark of over 100%. So it's good. So it means that 46% of the capital this firm has used is in the form of what? Debt. Right? 46% is the form of debt. It means that the firm has more equity. 46, so it means that you have 54% of the capital in the business being being equity, which is okay. Right? It means that the owners of the firm have invested more than what they have borrowed. And that is good. Right. Now, we look at the second ratio, also helping us to assess the financial risk of the firm. And that's the long-term debt over capital employed. We have learned today how to determine the capital employed of a firm. Who can refresh our memory on it?
That would be total current assets minus total current liabilities.
Who just spoke?
Mary.
Oh, Mary. The mother
She's
of
married to a Rotarian.
Oh, Dennis.
No, Mary. It's
It's
total assets minus current liabilities. No total current assets.
Okay.
Total assets minus current liabilities. Mary, the mother of Jesus. Is Hamza around? Okay, no, Hamza doesn't belong to this class, sorry. Capital gearing ratio. So long-term debt, our long-term debt is what?
2442.
2442. And then our capital employed.
Total assets.
We have already determined it. Capital employed. We have already determined it.
7713.
It's what?
7713.
7713. Does anybody have a problem with it? Capital employed. How we arrive at 7713. Does anybody have a problem with it? Okay.
Please, let's check the long-term debt. I think it is 2048.
It is 2048. Yeah, so 2048 class 394.
Okay. So
don't you see other long-term liabilities there? And right below the
please, I've seen it, sir. Please, I've seen it. Sir.
Okay, so our capital gearing becomes
approximately 32%. 32%.
Becomes what?
32.7, approximately
4.2 over 7713. And it becomes what?
32%.
Hey.
So how many in your mind they can?
32%.
Yes, sir.
Look at my brain.
Okay. Yes, sir. Approximately 32%. 32%.
Now, the standard is a company with a ratio of over 50% could be said to be highly geared.
Yes, sir. Please mute.
Our company has what, 32% as against the 50% benchmark. So we can say that our firm is less geared because it is only when it is over 50%.
When we talk about
that we say the firm is geared, is highly geared. Here, it is only 32%, far below the benchmark. So we say that our firm is less geared. Right? Now we get to the last dimension of the firm's performance. We look at the last set of ratios, investor ratios. All right. Okay. 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 So you will finish you will finish our listening also. I think that the other topics maybe one evening we may arrange to have an online discussion. If tomorrow you are unable to complete, we will maybe arrange. That will be from that will be an extra work that I want to put in to assist, right? It will not be part of the. It's not part of the timetable, but because we want to cover, I may have to arrange. If tomorrow you are unable to discuss that, then we will arrange one evening, 1 or 2 evenings. We can have an online discussion, right? For today, it appears we have used all the time. All right. So dividend per share. Dividend per share. So these are the ratios we are going to calculate. Dividend per share, earnings per share, dividend cover, price earnings ratio, and payout. Then we are out of this place, right? So dividend per share, the formula is projected here. I told you that don't worry about the formula, because if you are supposed to be assessed on this, the formula sheet to be provided, which will spell out all the formulas. So all that you need to look to is just to search for the suitable, appropriate formula for whatever you are doing. You use it, right? Because some of you are mothers and fathers and grandfathers, and you cannot keep these things in your head. Is that not the case?
Yes. Some are even great grandfathers.
Yes. Some of you are grandmothers and grandfathers.
Yes, bro. It's good to consider our age.
This part like this is a great grandfather.
Yes. And Dennis is a father, right?
Yes.
Well, Maggie, Auntie Maggie, your hand is up. Do you want to?
Please, so I want to find out all these calculations. Are there one question, like one question that you need to work all this calculation on?
Yes. If that is the case, if you examine on it, then one question, then you have to.
Hey, say. Let me start reading before.
Yeah, but you can easily do it. Don't worry yourself about grace to be given.
A new mother.
Don't worry. The Lord is your portion.
That's all.
Yes, sir.
The new child will bring some grace, some anointing that will help you solve every question with ease.
Amen. Amen.
The just shall live by faith.
Amen.
Amen.
And
you can do all things through Christ who strengthens me.
Amen.
I feel like preaching today. Amen.
So you're in the spirit.
Yes, I'm in the spirit now. All right. Now, dividend per share, we need to search for the dividend paid to ordinary. Please always check. We are talking about dividend paid to ordinary shareholders. Right? You may have dividend paid to preference shareholders. That is not part. If interested in dividend paid to ordinary shareholders. Sometimes to test your understanding, you may have two dividends in your question. Assuming that you are assessed on this, you must know the one that you are going to use. You must pick the right dividend figure. So we are looking at dividend paid to ordinary shareholders over the number of shares that the firm has issued, the number of ordinary shares, not preference shares. Right. So let's go through our income statement. Do we have dividend paid?
Yes. Yes, sir.
How much is that?
783. 783.
783. In the additional information, can you tell us the number of shares the firm has issued?
1 Ghana cedis per share.
Ghana cedi per share.
So if a share costs 1 Ghana cedi by the time the shares were issued, and you have 52 shareholders equity, which is shares, the total shares 5272, then it means that we have 5272 shares, right? Because
Yes.
if one costs 1 cedi, then how many shares were issued to raise the 5,272? Means that 5,272 shares were issued, right?
Yes. Yes, please.
Okay. So our number of shares is what? 5272. So dividend per share, that DPS becomes what? 783 over 5272. Summarize it for us.
15 pesos. That's 15 pesos per share.
It's what?
15 pesos per share.
Approximately.
Approximately 15
Pesos per share.
per share. So that is dividend per share. Now, as an investor, you must be interested in the dividend the firm pays, because when you invest in shares, there are two possible outcomes. In fact, three, but two positive outcomes that you expect. Capital gain, that is if the share price goes up above the purchase price, then dividend if it is declared. Right? So as an investor, you want as much dividend as possible. But you also want as much capital gain as possible. So when the dividend per share is high, it serves as an incentive or it serves as a motivation, sort of motivation to you as an investor. Right? So you want as much dividend as possible. Right? So that is dividend per share. Right? The higher the ratio, the better. Then you have earnings per share. So per share, right? Once you know to cover per share, then it means that obviously the denominator will be the number of shares, right? So here we have net profit or loss attributable to ordinary shareholders over the number of issued ordinary shares. Now, where you don't have preference shares, and that is where there are no preference dividends, the earnings after tax is what is used. But where you have preference dividend or preference shares, then it is the earnings after preference shares that will be used. After preference dividend, that will be used. In our example, we don't have preferences, do we?
No.
Okay, so our net income, which is the profit after tax, that is what we are going to use. So our net income is what?
$2,068.
Please, are you following me? It appears that...
Yes. 2068.
Okay, so our net income is what we are using. And I've given the reason why we are using our net income, right? because we don't have preferences. Now, if you have preferences, then the dividend payable on them will be subtracted from 20, that's the net income, and then it's the net that we will use, right? Yes, it's the balance that we use. That is net income less what preference dividend. That is what we will use for this ratio. Fortunately for us, we don't have preferences, so the net income automatically belongs to ordinary shareholders, and so that's what we are using. And then we have our number of shares. We already have determined that, haven't we?
Yes. Yes.
And the number of shares, we are interested in what? Ordinary shares, not preference shares. The number of shares is 52.72. All right, so our earnings per share becomes what? 2068 over 5272. Summarize it for us.
0.39 pesos. 0.39 cedis.
0.39 pesos. So 39 pesos. So that means that a share in this company has earned what? 39 pesos. A share in the company has earned 39 pesos. Please.
Does it translate into the capital gain?
No. The capital gain has to do with when the price
of the share,
the market price of a share goes up or increases above the purchase price. That's the price at which you bought the share. So let's say that you bought one share for say 1 cedi, but now the market price is 2 cedis. If you sell your share, you are going to get 1 cedi more. So your gain will be what? 1 cedi. That's your capital gain. Are you with me?
Yes, sir. Thank you.
So then you have dividend cover. We will close very soon. It's 4 o'clock. We will close very soon. Don't worry. So today we have spent all the day on the financial performance assessment. But that is good. It's worth it. So dividend cover. Dividend cover, we have so DC equals EPS over DPS. I think we have calculated these ratios, haven't we? Earnings per share, haven't you calculated?
Yes, Prof.
Yeah. How much is our earnings per share?
0.39.
It was
0.39.
Our dividend per share
0.15.
0.0 what?
0.15.
Very good. So our earnings per share, so our DC becomes what?
2.6.
0.39 over
0.15.
0.15. And that gives us what?
2.6.
2.6. We express our answer in times. So what it means is that looking at the current earnings of the firm, the earnings per share of the firm, right, and the current dividend per share of the firm, the earnings of the firm will be able to pay the dividend, the current dividend about 3 times, so 2.6, approximately 3 times. The higher the ratio, the better. Right? Yes. And as an investor, you want to know. You want to be sure that, especially if you're interested in dividend, you want to be sure that your investment will yield the needed dividend. So you want this ratio to be as high as possible, which will now give you assurance that yes, if you invest in the firm, or you continue to invest in the firm, the earnings the firm is generating will be able to pay dividend. So the higher this ratio, the better. Then we have we have price earnings ratio. Can we look at it? Can we proceed? Bismarck. Bismarck, are you there?
I'm here. I'm here. We can proceed.
Can we move on?
Yes, sir. We can move on for now.
All right. Are we speeding?
Oh, it's okay for now. It's okay for now, sir. We'll practice. We'll pick it up. So it's okay for now.
It's okay for now. For now,
it's okay. It's okay for now, sir.
All right. So market price per share. Equal market. How much is the market price? And then you have earnings per share.
5 cedis.
It's 5 cedis.
5 cedis.
And the earnings per share?
0.39.
So our price earnings ratio becomes 5 cedis over 0.39.
12.8. 12.8.
Okay. Now,
Sir, please, I can't see your screen.
you can see my screen.
I can see the screen, but then the working, the math you are doing. One you are writing now.
Okay. Is it okay now?
Yes, please.
Okay. So as an investor, how do you interpret this? So what is the answer, please?
12.8.
12.8. Right. Now, what does it mean? Now, assuming that, it is open to different interpretations. If you are, for example, if you are interested in, how long it will take for you to, as an investor, if you are investing in a share of this company, and the share price is 5 cedis, and currently a share is earning 39 pesos. How long will it take for you to get back your 5 cedis? Assuming that all the earnings per share is given to you, how much will it take? It is going to take annually, it's going to take almost 13 years, right, for you to get back your 5 cedis if you invest in the firm now. Daniel,
please, the 12.8, is it in years?
Fine, you can look at it from a year's perspective. I'm saying that this is subject to different interpretations. But I'm just looking at a situation where if you are an investor and you are interested in recouping your 5 cedis, and currently a share is earning 39 pesos, right? If annually a share is earning 39 pesos, and then if you are investing in you are investing 5 cedis, right? How long will it take for you to get back your 5 cedis, right? Assuming that that's what you are interested in. Okay, that is, we are interested in how long it will take for you to recoup your investment. Then it means that annually it will take you about 13 years or so for you to get back your initial investment, which is 5 Cgs. So currently, it is 39 pesos. A share is earning 39 pesos. And if you are buying it for 5 Cgs, how long will it take? Look at the current earnings for you to get back your initial investment. Right? No, as an investor, in fact, you can read more. Another interpretation is that it is believed that if this is low, but as to whether what constitutes low is not known. If it's low, it means that the firm you are assessing is undervalued, right? And it's that the share price is undervalued, right? Yes, if it is low. Okay, so you can read. I will encourage you to read more on the various interpretations that can be given to this particular ratio. But remember that it is supposed to be used by an investor. So these are investor ratios, right? They are used by investors to assess, organizations or companies in order to decide whether to invest in them or to move away from them if they have already invested in them. Okay. Then you have payout. And then that's the last ratio. Then if there are no questions, we leave. And we'll continue tomorrow. I understand that Dr. Akopi is having a meeting with you tomorrow. He's going meeting with you tomorrow, right? Is it correct?
Yes, sir.
Correct. True.
Okay. But I have a letter in the morning, so I will not be able to take it. I will not be able to take it. So I have to come. I have to be with you around 11. Yeah, 11. I'll finish in the morning lecture. But in case I'm able to finish early, I'll prompt the class rep so that we start early and close early. Because some of you, today, for example, in fact, it appears you have used the whole day. Some of you are grandfathers, you are husbands and wives, and you need to attend to your partners.
And some of us need to go and attend to our concubines.
You need to do what?
Go see our concubines.
Concubines?
Yeah.
If you are married, or what concubine? You even the one that you have, can you manage her? Managing one woman is a whole course. Oh, sorry, no apologies to the woman, because they will take offense. Mrs. Abu, please. I've withdrawn my statement. I've withdrawn my.
My statement is factual.
Hey, be careful. Be careful. Okay, so the payout ratio equals total dividend paid to ordinary shareholders. So what we have our dividend, don't we? Don't we have our dividend? How much is our dividend, please? It appears there, please. How much is our dividend?
0.15.
No, dividend.
783.
Okay, earnings after tax and preferred dividend. We don't have preferred dividend, do we?
No.
So we take earnings after tax, which will be our net income. How much is our net income?
2068.
2068. So our payout ratio becomes 783 over 2068. Somebody will summarize it for us.
.37. So 0.4.
0.4.
37. Approximately 0.4.
So what it means is that, you see, the payout, we want to know, so under normal circumstances, the 2068 should have been paid to ordinary shareholders of this firm. But the board of directors decided not to pay all. So out of the 2068 that should have gone to the ordinary shareholders as their dividend, the board only paid what? 783. All right, 783. Which means that about so this one, if you express in percentage, so only 37% of what should have gone to the ordinary shareholders went to them. So how much was retained? I mean 63, right? 63% of the earnings that should have gone to ordinary shareholders was retained by the board. So once you know the payout, you can get the retention ratio by subtracting the payout from 1. So if you subtract the payout, that's 0.37 from 1, you get what? 0.63. So the retention ratio is what? Is 0.63. Once you know the payout, you can always get the retention ratio by subtracting the payout ratio from 1. If you subtract it from 1, whatever you get will be the retention ratio. Any questions or any questions? Any concerns, frustrations, insults? Yes. Any question or questions? All right. So what we will do is that tomorrow, God willing, we will look at the qualitative aspects of the course. We discuss some topics. If you are unable to finish discussing what you are supposed to discuss, we will have to arrange some meetings outside what the university requires, so that we can cover what you are supposed to cover. But if the class thinks that, well, they can read, then I will have no problem. I'll just make the notes available so that you can do your own reading. Right. So I will encourage you to go over, revise what you have discussed today. Tomorrow, if you have any question, in the first few minutes of our meeting, I will open the floor for you to ask your questions, and then we discuss what you are supposed to discuss. But what I will encourage everybody is that don't be afraid. In case what you have done today, you have not understood it, when you go home, master courage, go over, and you'll be fine. They are not, what you have discussed today, they are not difficult at all. The ratios are not difficult. You only need to understand them. You only need to know the formula. And once you know the formula, it's a matter of just inputting, picking the figures and then putting them in the formula, and you'll be okay. Right? So don't panic. Don't panic at all. Don't get worried at all. Because you will make it. Right? You will make it. I know that you will make it.
Amen.
You are more than able to understand and apply what you have learned today.
Hey, Prof, I can see your emails.
Pardon me?
I can see your emails. It's gone.
You can see my...
I'll see your email.
Oh, I don't get what you are saying.
He said he was seeing your email.
Yeah.
My input.
Emails, your bill.
Oh, yeah. I normally I put my my slides on online, so I download. And then sometimes I go into my mail and especially intermittently, sometimes you check things, you confirm things and all that. So yes, my email, I was just trying to close it. I think I've closed it. Right. So let's meet tomorrow. But in case I have a lecture in the morning, in case I'm able to finish early, I will just be on standby so that we can start early and close early. All right.
Thank you very much, Prof.
Any question or questions? I know that when you teach, a topic like this,
No.
you become okay. Somebody's hand is up. Is that
That's Eleanor.
Eleanor Tete?
Yeah, Eleanor.
Sir, I wanted to ask if, instead of a weekday, we can do next weekend, since next weekend is supposed to be.
Instead of the video, we can do it.
No, the weekday. Next weekend is supposed to be for midterm, so.
Please, no.
No, please. We also have things to
Please,
do.
no. Please, no.
No.
Okay.
Thank you.
My colleagues are beating me, so
I will not encourage a weekend because people, for example, Mrs. Ado, she has not been given.
The weekend is not favorable. What I'm talking to you,